Hi everyone, my name's Darryl Panes, CEO at As Good As Gold Australia, and I'm joined once again by my brother Brian, and partner at As Good As Gold. And today we interview Chief Economist John Adams. Good morning, John.
Good morning, John.
Good morning, Darryl and Brian. How are you going today?
Well, I would say before Darryl says anything, it's in Adelaide, it's 37 degrees, and then if the Americans are watching this, that's 100 degrees Fahrenheit. Yes, we are in an air-conditioned room, but let me tell you, when you walk out of the house, it powers you on. So it's a warm day.
Oh yeah, yep, summer in its earnest. And so the spending continues, John. Seems to be no end to this economic stimulus. Without it, it would seem that the economy would fall off a cliff. Not just here in Australia, but all around the world. Without JobKeeper, JobSeeker, which ends this March, I think it's something like 1.5 million jobs that are reliant on JobKeeper, JobSeeker, so are in jeopardy if it doesn't continue. And unfortunately, though, with all of this spending, John, and devaluation of currency, it leads to high levels of inflation. So I know last year, 2020, you told our viewers that stagflation had already commenced. You've since published a new article confirming that under the Biden administration that we're going to witness accelerated stagflation. Probably mainly for our the new viewing audience, but can you recap for them what stagflation is? I think that'd be a really good start.
Fantastic. Yeah, happy to answer that question, Darryl. So basically, stagflation is a situation where you have low economic growth, high unemployment, and rising prices. Now, the last time we had stagflation was in the 1970s. And it posed a very big conundrum for Keynesian economists, because typically under the Keynesian economic paradigm is when you have rising unemployment, it's because that there's a lack of aggregate demand in the economy. And if there's a lack of aggregate demand, prices should be falling, not rising. So when prices started to rise in the 1970s, at the same time, unemployment was high and economic growth was low. That caused a different set of challenges compared to where we were in the 1960s. And so going into last year, we had obviously the lockdown. We had the pandemonium about COVID-19. We had a huge collapse in the stock market, and then we had the announcement in March of last year of QE to infinity, but by the central banks, and fiscal stimulus as well. So as we went through 2020, we started to obviously see economies around the world go into recession. We started to see unemployment go through the roof. At the same time, we saw the money supply. It was rapidly increasing, both overseas and, for example, the United States. Whether you look at, say, M2 or whether you look at the US Federal Reserve balance sheet, which now is about 7.4 trillion, whereas in 2019 it was at 3.8 trillion. But also when you look at the Australian money supply, if you look at broad money, annualized growth rate went, as of December of last year, it was up at 12.6%. So we definitely have seen a lot of inflation. Now, some of that inflation is still working its way through the system, but we are starting to see some aggressive action in the real estate market across the country, particularly in housing. Apartments, different story, but we are seeing this this situation of high unemployment, underemployment, weak economic growth, and rising prices. And so obviously, as you mentioned, Darryl, about JobKeeper, JobSeeker, which comes to an end next month, that will cause some quite huge implications for about, like you said, 1 million to 1.5 million people, and that will cause further issues in terms of people's employment status, in terms of people's income, their ability to meet their cash flow obligations, particularly if they have a huge mortgage, and that will cause further weakness after that stimulus is ended as we head into April.
John, there's constant reference, and our Treasurer just recently, of course, stated that we were moving out of recession. And yet, I constantly hear that if we drop JobKeeper, JobSeeker, that our economy is going to fall into disarray. Isn't that some form of contradiction? I mean, to say that we're moving out of recession, and yet we desperately need to retain JobKeeper, JobSeeker to keep this economy focused.
So the answer to that, Darryl, is so it depends on how you sort of think about economic growth. So there's a particular formula that John Maynard Keynes sort of set up, and what drove the economy to become out of recession late last year was a rise in government spending, but also because of JobKeeper, JobSeeker, and there was a whole bunch of these sort of buy now, pay later services like Afterpay. You did see a rise in retail sales consumption in the fourth quarter. So we saw a very weak environment for business investment, but consumption and government spending went up. So that's what's obviously driven us technically out of recession when you look at GDP. Now, obviously, if JobKeeper, JobSeeker, if that stops and we start to see a dramatic fall in government spending, at the same time we start to see households tighten their belt in terms of spending on things at the shops, that will then definitely weaken the economy, and we could either see GDP going, very low, or we could go back into negative GDP growth, which would put us back into recession. So we're in a catch-22, but it really depends on how you measure GDP. The only thing I will say about what happens when we get to April is obviously this year is highly touted to be an election year. Now, technically, the government could go to the polls next year. Now, my sources in Canberra tell me that the Prime Minister is laser focused on winning re-election and he cares about nothing else. So if JobKeeper and JobSeeker were to end next month and we start to see significant weakness across the economy in April, May, June, dare I say we will see some additional stimulus announcements either from the federal government or the Reserve Bank in terms of monetary stimulus in order to keep the show on the road until we get to election day.
Accelerated stagflation, you've made reference to this term before. What does it really mean?
So what I mean by accelerated stagflation is that this stagflationary process that I just talked about, I think it's going to get faster, particularly because now Joe Biden is now the president of the United States. And the reason why I say that is that I think from memory, Biden has inherited a deficit of about $2.3 trillion in terms of the deficit he inherited from Trump. So that's point one. Now, before I actually talk about the policies of Joe Biden and why I think he's going to make it go faster, think about what happened with Trump. With the Federal Reserve, they took interest rates to zero. They started printing like crazy. They blew up the balance sheet to, like I said before, 7.4 trillion. The federal deficit under Trump in his last year went to $3.1 trillion. Now, we started to see part of that stagflationary process in the United States go through the system last year. But when you make these decisions, those decisions do take some time to flow through to the system. And so a range of those decisions that Trump and the Federal Reserve made last year will carry on into 2021, if not 2022. Now, as we look at the first few weeks of the Biden administration, so like I said, he comes into office with a whole bunch of stimulus that was injected last year by Trump. And to add fuel to the fire, they've come out of the gate swinging with a $1.9 trillion COVID relief package, which to the best of my knowledge has passed the Senate, and I'm not sure if it's passed Congress yet, but given that the Congress is controlled by the Democrats, I expect that package to go through. And then on top of that, the Biden administration has announced a $2 trillion climate change package, which looks at reducing emissions, increasing investment in renewable energy, as well as investing in various infrastructure that makes transportation more efficient. So we have record fiscal stimulus. We have the balance sheet of the U.S. Federal Reserve at unprecedented levels, and Biden comes out saying we're going to add $4 trillion worth of spending. And I should just clarify for the audience, with the climate change package, that's $2 trillion over 4 years, whereas the COVID relief package is $1.9 trillion that they want to spend within the next 12 months. So when you add all of that together, the deficit is going to blow out again. That's going to mean that the U.S. Treasury under now Janet Yellen will have to issue a record amount of bonds, new bonds. And then on top of those new bonds, they've got a whole bunch of existing bonds, which are very short-term in nature, which they continually have to roll over. And given that there's a lack of foreign demand for US government debt at the moment, the only way that they can finance this increase in terms of the deficit and rolling over this existing debt is by printing ever more amounts of money. And so I think we're going to see an accelerated amount of monetary stimulus coming out of the Federal Reserve, and all that money has to go somewhere into the system. And obviously, we're seeing, I think in the last 24 hours, Bitcoin has now gone to 50,000 US. And you look at the stock market at an all-time high. Property is huge, very expensive, and bonds, particularly at the short end, their prices are very high. So we are seeing huge amounts of asset bubbles, and that inflation is going to start seeping through to the real economy. And we can talk about that in a second as to what are the signs that I think that is going to manifest. But the other key point around this accelerated stagflation is Biden has brought in a number of policies already, which is costing Americans tens of thousands of jobs. So from rejoining the Paris Accord, which means that they'll have to reduce jobs in fossil fuel industries, to stopping construction of the Keystone XL pipeline, which is the pipeline from Canada to Mexico, to stopping the construction of the border wall between between America and Mexico, and also stopping fracking in terms of federal government land. And under the Trump administration, there was a significant amount of jobs that were created in the oil and gas field. Now, to add insult to injury, the Biden administration is looking at raising the minimum wage to $15 an hour, which even the Congressional Budget Office has said that's going to cost about 1.5 million jobs. So at the same time that you've got all this stimulus, which is going to fuel inflation by exploding the money supply, we have a whole host of laws and regulatory policies which are costing jobs, and I think that's going to make unemployment higher. It's going to make it it's going to increase underemployment, because particularly around raising the minimum wage, it's going to make it more expensive to employ people, and either they'll put people on less hours, or they'll switch to using machines so they can save on labor costs. And obviously, we have this situation of unemployment, I think, will be stubbornly high with these policies, and we're going to see rising prices with weak economic growth. And I think that Biden is going to make this stagflation process faster, and that's why I wrote an article on my website. We wrote a newsletter for our clients about accelerated stagflation, and that will have huge implications for not only America but across the world, and particularly for middle income families, because if you have less income and your prices are going higher, it means that your budgets are being squeezed, and that means that it is just harder to pay for the necessities and have a good standard of living. And obviously that's why in the 1970s, gold and silver was a key factor in maintaining people's living standards, because gold and silver prices went up quite dramatically as with the inflation, and that was your best defense against people's wealth being destroyed through inflation, and people's disposable incomes being squeezed through this process.
This is why you're saying, I guess, that with reference to accelerated stagflation, that's the most important storyline for people around the world, and they should be focused on right now. That's what you're saying.
Correct.
Yeah.
All right, John. Yeah, a lot of information there, and you brought up my next two questions are going to be about the performance of gold and silver, and we'll come to that in just a minute or so. It was interesting that you brought up the inflation, that we've seen inflation in the stock market, in the real estate market. I'll give you a very good example. 2 years ago, pretty well to this day, the next door neighbour's home was sold. It's a very big block of land. We live in an area about 8 minutes drive to the CBD, so it's relatively close to the city of Adelaide. And this particular block of land is about 900 square metres and sold for $605,000. 2 years later, only 2 weeks ago, I was at an auction across the road from here. This is a block of land with a building that you could only call a knockover. No real advantage to keep this particular house on the land. So that's what will probably happen. And this block of land, as I call it, went for $805,000. So $200,000 increase over 2 years. Now, interesting enough, I mean, the food prices haven't gone up. None of that's gone up. Stock market's up. Land prices are up. Now, it's all very well to say, well, your land prices go up, but if you want to buy another piece of land in the same area, you're going to be paying the same amount of money. So the only advantage you have got, if you move out to about 50 minutes away from Adelaide to buy a house and land package for about $500,000-600,000, but you're nearly an hour away from the driving time. So that's what inflation is doing. It's creating a bit more money for the haves and a lot less money for the have-nots. Right. The question is, and I get asked many times, what is silver and gold going to do? We hear about the inflation, stagflation. So my first question is, in the last official period of stagflation in the 1970s, gold and silver were the best asset class to hold in performance relative to other asset classes. Can you provide, John, an overview of how gold and silver performed during that period of 1970s?
A lot of our viewers would know about what Richard Nixon did in 1971 when he closed the gold window. So prior to that, gold was fixed at $35 US an ounce. By 1980, when gold and silver peaked, and in 1980, that was the end of the Carter administration in January 1980, before Reagan came in, gold went to $850 per ounce. So over the course of the decade, an ounce of gold went up 2,328% over 10 years. And obviously, if you accumulated and you held that sort of gold, I mean that's a phenomenal amount of rate of return, and for those that have that gold, they have the ability to preserve their wealth. Now, when you look at silver, in 1970, silver was about $1.80 per ounce US. By I think the 22nd of January 1980, silver got to $49.45. So in the context of silver went up 2,647% over 10 years. And that's why, relative to cash, relative to bonds, relative to the shares, or relative to real estate, gold and silver outperformed all asset classes. And it was your best defense against stagflation. Now, the other point I'll make is that, and I should have sort of mentioned it earlier in the conversation, is what happened in the 1970s was stagflation started in 1974, 75, 76 under Richard Nixon and Gerald Ford. But then when Jimmy Carter came in, the amount of inflation started to go quite dramatically under his administration, because he was spending the fiscal deficit, that was becoming quite aggressive. And also the policies of Gerald Ford and Richard Nixon, it took a bit of time for that to flow through to the system, and it started to really kick off in 1977. So, and then I should also say that gold and silver, when they started, they were rising from 1970 through to 1976, but they really took off from 1977 through to 1980 under Jimmy Carter. So the parallels, I think, for today is that kind of like what I said, Trump has started the stagflation process. And when you look at what happened with gold and silver prices last year in Australian dollar terms, I think gold was up 13.7%. Silver was up more than, I think, 32.4%. So there was a very strong year for gold and silver in Australian dollar terms in 2020, and that is what you expect when you have the start of stagflation. But what I suspect will happen is that stagflation process will, as it gets faster under Biden, because of the reasons which I just gave before, similar to Carter, the rate of change for gold and silver, that will go up more dramatically relative to last year.
Yeah, so reading between the lines there, we have a combination of President Carter being the same sort of person as Biden. So as Biden starts to put his to share the money around, that's what will be the next couple of years. Should be exciting for gold and silver. Darryl?
Yeah. John, look, in the last couple of weeks, there has been a lot of global attention in the silver market and the dramatic short squeeze and share price action with American retailer, of course, GameStop. For those people who didn't follow this action very closely, and it caught us all by a bit of a surprise. Brian and I, in fact, just in advance of this, were away for a 4-day holiday. 4-day holiday in the Riverland. We just thought we needed to have some time off. And we heard about this, and it forced us to drive to the top of the hill.
Because there was no reception.
We had no reception at all, none. So we had to drive to the top of the hill. It was about a 6-kilometre drive each day away from the river and the shack where we were staying, just so we could get some information and come back and analyse what was going on. So it all happened in an absolute dramatic rush. But for those who didn't pick up on all of this, can you explain to everybody what happened in the silver market?
Kind of like what you said in terms of the premise. So there was a lot of there was a short squeeze that happened in terms of GameStop. So it's a particular American company that sells computer games. A lot of hedge funds had shorted that stock because it was at the beginning of January, it was worth about $18 a share US. And given the amount of debt that the company was in, and given where the business was heading, a lot of hedge funds thought that it was worth a lot less than $18. So they thought that as the share price is going to fall, they can make a lot of money as it falls. And then you had a whole bunch of people who said that they shorted it. So the shorting of the stock is basically a contractual obligation that they're going to promise to in terms of selling the shares. But there was a promise to sell 140% of the shares, or 130% relative to the amount of shares available. And some smart people thought, well, if they can pile in money and drive the price up higher, these hedge funds will be forced to buy these shares at more dramatic prices, which means that all this additional buying would drive up the price to an exponential level, number one. And number two is it means that the hedge funds who were betting that the price would fall would have huge losses. And in the course of the 3.5 weeks, the price went from about $18 a share all the way up to, I think, $483 a share. So those who were able to enjoy the ride up, they made a lot of money. And obviously those who got in late, and as the price was started to fall because it's going to its real value, they lost a lot of money. And in the process, there was one or two hedge funds that required a bailout. And there was one hedge fund, I think, from memory, who got a bailout from another hedge fund to the tune of $2 billion. So the losses for some of these hedge funds in GameStop was quite dramatic. Now, that sparked a lot of media interest. Everyone started talking about this, and obviously there's this Reddit group called Wall Street Bets who was telling people to pile into this GameStop share because of the ability to bankrupt some of these hedge funds. So as the people started to focus on that, then people started on this Wall Street Bets started to talk about silver. And that started the buzz. And then the weekend you guys were away on your holiday, what was trending on Twitter was silver squeeze. And it was in the top trending tweets in Canada. It was in the top trending tweets in Germany. And it just became this global talking point about, well, just like there was an opportunity with GameStop to drive the price dramatically high and bankrupt some of these hedge funds, the word got out, well, there's a dramatic opportunity in silver, and there's an opportunity to bankrupt some of these Wall Street banks. And so because of this buzz, what we started to see was unprecedented retail demand, particularly in North America, particularly in the United States. A lot of these retail dealerships, kind of like us, got cleaned out, and they got cleaned out within a few days. Premiums started to explode. The delivery date that the dealerships promised to deliver blew out. I was just looking at one company in America called SD Bullion, and they basically said, it's going to take us at least 10 business days to deliver any silver because the supply chain has been stretched. So now I should say that some of my contacts in the Asia Pacific region, I touched in with them and just to see what's happening with retail demand in the first few days of this happening, and they saw huge amounts of buying, kind of like even more so than March of last year, and obviously a number of Australian retailers saw their silver sales go up, and obviously we were one of them that saw a lot of customers wanting to buy because of the public frenzy. But the amount of intense demand in the United States, that was unprecedented, and that's obviously had huge implications for the silver supply chain, particularly in terms of wholesalers and in terms of the miners, in terms of being able to access enough silver to meet demand. So a lot of action happening there, and because of that demand, what we've started to see is, even though that this Wall Street Bets group started this frenzy in the retail market, we also started to see some big fish with some big money also paying attention to the silver market, and we started to see huge amounts of demand for what we call the wholesale market, which is 1,000-ounce silver bars, and these are the bars that are used with SLV, the ETF, as well as with the COMEX. And so I think last week what we are seeing is that a number of American commentators saying that the premiums on wholesale 1,000-ounce bars are the highest they've ever been. And again, when you start to hear people who've been in the industry for 20 or 30 years saying that we are seeing things that have never been recorded before, it says that we're actually entering into a new paradigm. So I think so just to recap, obviously we saw record demand at the retail level. We saw huge demand at the wholesale level, record premiums. We saw massive inflows into the ETFs, and the biggest ETF in the world is SLV, which is managed by BlackRock, and the custodian is JP Morgan. So within a 3-day period, they issued about 118 million shares, which under their perspectives requires them to deposit 118 million ounces in their vault. And a lot of people who've been in the silver industry for a while saying, well, how do you physically get 118 million ounces and physically put it in a vault? And so there's now been some very big questions about SLV, the integrity of it. Do they actually have the silver? What we have seen as a result of this Wall Street bets phenomena is that SLV has changed its prospectus. They are now saying that the amount of shares on issue may not match the amount of physical silver that is actually in their vaults. And that to me is effectively that they're admitting that they have defaulted on their shareholders. So under their prospectus, the requirement is that if they get a new investor who buys into the trust and they issue new shares, the requisite amount of silver consistent with those new share issues have to be put into the vault, and that's what JP Morgan has to do. And now they've changed their prospectus and saying, well, we may not be able to put all the silver consistent with what our obligation to you, what their obligation to their investors are in terms of their initial commitment. So we're starting to see a lot of stress in the silver market, and we saw some very big action in the price. So I think perhaps, and remind me, Darryl and Brian, before you left for your holiday, maybe silver was at about $25 an ounce US. It got all the way up to about $30.10. Then it got slammed down to about 27. And I think this, when you have unprecedented demand and people struggling to get the metal, it makes no economic sense for the price to fall 10% from $30 an ounce to 27. So, we've spoken at length about manipulation, not only in terms of myself, but last year you've interviewed a number of people who have spoken about manipulation at length, including Bill Murphy from GATA. So I think that the world got to see the full extent of the manipulation that we saw when the price went from 30 down to 27. Now the price is stabilizing around 27.5. And where we go from here, so today in Australia it's the 17th of February, we are seeing a record, again, the demand hasn't let up. So the demand at the retail level, at the wholesale level, it is still intense. When we look at the March contract for COMEX, the amount of open interest is about 80. Look, I'm just looking at the screen. I think it's about 87,000 contracts. Now, by next week, we'll find out exactly how much silver will have to be delivered to those who stand for delivery. But I think the name of the game when we talk about the silver market and where we're really headed with this is the more physical silver that can be drained either through retail demand, wholesale demand, or in terms of SLV. And I should say with SLV that under the prospectus, if you have 50,000 shares, you can go to the trust and actually have those shares converted to physical. And there has been some speculation in the last 2 weeks that certain large players are actually trying to drain silver out of the vaults out of JP Morgan through this SLV process. But just kind of like with what happened with palladium 2 years ago. So palladium went up 400% in price because when they had to come up with a metal to meet their contractual obligations at the COMEX, they just ran out, and they needed the price to go up so that they could entice people to sell in order to meet their contractual obligations. So I think silver, what we're seeing is a lot of silver being bought, a lot of silver being drained out of the system. The sharks are starting to sniff around and they can see this manipulation out in the open. And the real question now over the next 2 or 3 weeks is how much silver will be required to be delivered for the March contract, and can they get it, or will they need to let the price go higher on the hope that certain people are going to sell so they can meet the record demand of silver to be delivered?
Before Darryl finishes off for this morning, I just want to I want to summarise what you've just said to the audience. Not as if you explained it incredibly well, but I look at the mining shares quite often, and I know how much silver and gold comes to the market. But this is how I summarise all of that. So Monday, the 1st of February 2021, SLV, which is the ETF of silver, it's a paper contract, sold shares to the value of 118 million ounces of silver. Now that is 14% of annual mine output. The annual supply of silver is 800 million ounces per year. So how would you find this huge amount? Would you buy it? Would SLV buy it, or would they lease it from JP Morgan? It'd be interesting to find out, Darryl.
What I'd like to add is that I think we've got lots to look forward to. Lots to look forward to. Why do I say that? These markets have been manipulated for a long time. And yet, since 2000, right through till now, 20 years, gold has still returned 20% per annum to the investor. On average, 20% per annum. Now, that's a fantastic return in a manipulated market. Now, with this manipulation process that we talk about has been getting stronger and stronger. The major players, the JP Morgans of this world, have been very influential. But having said that, we look at silver over since March last year, through till now, we're talking in US dollars, and that's the way most people talk about precious metals. What's it trading at the moment? It's US dollars. In US dollars, silver is up just under 100% since March last year. Now, these are extraordinary numbers, and this is in a manipulated market. Just recently, Ted Butler, who's an absolute expert in the precious metals market, said this is the time you buy. This is the time you buy precious metals. You buy, because some people will say, why would you buy in a manipulated market? He said that's when you should, because especially if they're forcing the price of the metal down, because that's when you should be buying it. Now, those who bought silver in March last year did very well out of the exercise. That's nothing compared to what we're going to see in this explosion of silver prices when they absolutely lose control of this manipulated market. We can expect to see prices rise to a point that no one's ever seen before.
Just take a look at Bitcoin. Everybody thought 20,000 was the top.
Yep.
Now it's 50,000. So and talking about 100,000. So silver has got a long way to go.
Oh, and look, Stephen Lieb talked just recently about $20,000 gold, $200 silver. Now, we're talking spot price US. So we're talking
300.
8 times. 8 times where it is.
Australian.
300. So we're 8 times where it is now. Now, for anybody who has a considerable amount of holdings in silver and or gold, and we see a price increase of somewhere around 6 to 8 times, they can look forward to an early retirement. So I think there is so much to look forward to. John, before we go this morning, what I'd really like to do is ask you for some closing comments. I'm sure you'd like to share some points with our viewing audience. Stage is yours.
So what I would say to the audience is, I think there's 2 key points that I want to get out of today's discussion. The first is that when you look at the macro picture, when you look over the next, not only just 12 months, but over the next few years, the amount of money printing, the amount of stimulus that is going to occur, that's really going to drive where these markets go, because this money has to go somewhere. And I do expect we're going to see more inflation coming through the official statistics. So America and New Zealand, they have some numbers around inflation expectations, and the expectations around inflation, that is going up. And so as this process goes faster in terms of inflation, that's going to come through the system. Now, there are some people, again, Harry Dent and others, talking about a market crash. What I would say is that the establishment understand that if the market does, like when we say crash, now it could correct. So the stock market could fall 20%. But in terms of a real systemic crash of 60, 70, 80%, this would bring the banks and the financial oligarchy to its knees, and they want to avoid that like the plague. So it's in their interest to keep this bubble going, and they're going to do that by just racking up ever more debt, printing ever more money, and that's obviously going to drive financial markets over the next few years, and that's the big takeaway. That as people have a medium-term horizon, well, what is that horizon looking like? So far, it's going to be looking more of an stagflationary mode, as opposed to any sort of deflationary sort of situation. But then on top of that, we have a manipulated market which has been stressed in the last few weeks. We're starting to see unprecedented things in the silver market. And obviously, if the silver market does blow up some say the next few weeks, some people say it'll take a few months, but if it does blow up, we're going to see a dramatic rise in price initially. And then as this stagflation continues, I think that price rise will even continue. So I know that you said that, Darryl, about potential for silver to go up 8 times in US dollar terms. Well, early in this conversation, we said that during a decade, silver went up 26 times in 2,600%.
Yeah. So we're not exaggerating. No.
The end point of when silver and gold will stop to escalate is when the central banks decide to change course and start to drive up interest rates so that we can get this inflation under control. So far, there's no evidence that there's any intention to do that, because once you start to raise rates, we have the biggest debt bubble in the history of the world. That means we're going to have the biggest depression known to man. So at the point when you start to see dramatic increases of interest rates by central banks, that's probably the time when silver is going to reach the top, but also in terms of gold. But for now, Yeah, so I think 6 to 8 times is perhaps the minimum we could look at, and just like in the 1970s, it could be 20x or even 26x depending on future public policy.
Yeah, I mean, history is a great teacher, isn't it?
That's what I like about history. It is a great teacher.
Some people think they're smarter than history, John, but I haven't met anyone yet. It's interesting that all of the people that we interview, and they're all very smart people, they're all on the same page, and they're all talking silver to $200 an ounce. And if we get hyperinflation, everything goes into the stratosphere. So, good place to be. I mean, it's typical of Jim Sinclair. Once again, we always refer to him because I think his comments are extremely valid. Become your own central bank. Why do central banks own gold? A lot of them at the moment would like to think they had more than what they do.
Yeah, that's it.
But why do they own gold? Because it's security, it's insurance, it gives them power, it gives them influence. Why wouldn't you want to be your own central bank? Follow their lead in that respect. Look, at that, Brian, I'd like to thank John again. John, thank you for your research, mate, and your wonderful input at As Good as Gold Australia. It's been, I remember that first day we met, and we thought, well, hey, yeah, look, we're on the same page, why don't we give this a go? And here we are 2.5 years later, and it's all looking great. It's been tremendous having you on board. You've been a wonderful acquisition, wonderful support to As Good as Gold Australia. Thank you so much, John, and look forward to your ongoing work. We'd also like to thank our viewing audience, our subscribers who continue to support our channel. Thank you so much for that. And I guess until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.